The U.S. will never default. That was the reassurance from the U.S. Treasury Secretary just yesterday. But only a day later, the financial report from the Bank of Japan, BOJ, reveals quite the opposite. A record-breaking loss of 28.6 trillion yen, equivalent to 198 billion USD. And you know what? This isn't just Japan's problem. It's a red warning flag for the entire global financial market. The Bank of Japan, BOJ, currently holds an enormous amount of Japanese government bonds, JGBs. For years, they purchased these bonds to keep interest rates low and stimulate the economy. But now the tides have turned. The 10-year JGB yield has jumped from 0.73% to 1.5% in just 1 year. That surge has caused the value of older bonds on BOJ's balance sheet to plunge. As a result, the unrealized losses have ballooned to 198 billion US dollars, 3 times higher than last year, and the largest in BOJ's history. It's not a loss until you sell? Technically true. But here's the real issue. BOJ has withheld 100% of its income this year to cover these losses, instead of transferring profits to the government, as usual. This is a clear defensive signal. The storm isn't over yet. The problem doesn't lie solely with the Bank of Japan. Other major Japanese financial institutions are also bleeding assets. For example, Nippon Life Insurance has posted a paper loss of 3.6 trillion yen, in addition to 500 billion yen in realized losses after being forced to dump low-yield bonds and shift toward higher-yielding assets. Foreign investment funds, once enthusiastic buyers of cheap Japanese bonds, are now backing away due to extreme market volatility. And it's not just the bond market under pressure. Japanese equities are also experiencing a historic exodus. In just 1 week, over $11 billion was pulled from Japanese equity funds, the largest weekly outflow on record. The 3 largest ETFs tracking the Topix index alone lost $8 billion. Most alarming of all, investors aren't rotating into long-term bonds. They're withdrawing completely from both stocks and bonds. This is no longer a localized disruption. Japan is the world's largest bond investor. Japanese institutions hold massive amounts of U.S. Treasury bonds, European government bonds, emerging market assets. So what happens when JGB yields rise? Japanese investors repatriate capital, shifting back into higher-yielding domestic assets. Lower demand for foreign debt, higher global borrowing costs, carry trades collapse, cheap yen funding no longer flows abroad. The result, bond markets in the U.S., Europe, and emerging economies face upward yield pressure. Currency markets become volatile. The yen could surge, triggering a global liquidity shock. When a fuse like Japan burns out, the entire global financial grid is at risk. The Bank of Japan is no longer the silent central bank, and Japan is no longer the anchor of global financial stability. Right now, while the world is euphoric over risky assets, crypto is rallying and stocks are bouncing back. Cold winds are blowing, distant thunder rolls, dark clouds gather on the horizon, but only those who are sensitive, who know how to observe, will see them. The majority, they'll only notice once the rain has already begun. If you found this video helpful, don't forget to hit the like button. Share your thoughts in the comments and subscribe to the channel so you won't miss the latest updates on global financial shifts.